We were already in recession back then. We had the Fed funds rate at 10% during the month of October. We had the 10-year yield being below 7%, so not a surprise. We had an inverted yield curve. We also had inflation at 4.3%, whereas today we're looking at inflation that's less than half of where it was back in '73. We're looking at a Fed funds rate that is still below 1%, so therefore 1/10 of where it was back in '73. And the 10-year note remains well below 3%, so more than half of what it was back in '73. So things are very, very different. We still have a steep yield curve. This time around, 2017, the S&P is up 12% since Election Day, and it's up 6% since Inauguration Day. And despite the news about the FBI director, the market is still challenging its all-time high, which is a shade above the 2,400 level. Of course, it took about a week back in 1973 before investors started to lose confidence in their leadership and in the market itself. So who knows whether we end up having a delayed reaction this time as well. My feeling is that it'll be more of a dip that gets bought into because the factors that point to recession, year-on-year change in housing starts, consumer confidence, 6-month movement in LEI, and the yield curve, none of them is pointing to a recession.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.